Why is Galaxy Surfactants an interesting play? Because that's the company we're going to talk about today. Now, let me take you through the 5-day, 1 month, maybe 6 month, 1 year, as well as 5-year chart. And what you'll see is an extremely interesting trend. Let's bring that up quickly on the screen. That's, of course, the 5-day trend. The last 7 days, stock is up 13%. Mind you, viewers, that's something to note. But outside of that, let's pull up the 1 year, the 6 month, 1 year, very, very quickly. That's the 1 month. The 6-month chart will show a negative 9% return. The 12-month chart will show a negative 12% return. And the most fascinating one will be the 5-year chart. And I'll freeze that 5-year chart for just a minute. That's, of course, the 52-week chart, which is the 1 year, the 5-year chart. Look at that. We are at the bottom with regard to how stock price action has moved. It's given a negative 7% 5-year return. And we've seen this stock come just off the lows of that 5-year chart. And that's why this looks interesting, because it's a play on India FMCG. And if we could start to see an uptick there, as well as global FMCG, with some good tailwinds with regard to raw material costs, this could just start looking very, very interesting. So how has the demand recovery in India been? First, that's what we're going to try and understand and talk about. The second piece is with regard to US and EU. In terms of the US and EU, the tariff reversal, how is that going to impact its numbers? Because a large portion of the top line comes from these two geographies, and we talk about that in just a bit. In terms of raw material pricing trends, now I know they pass on that raw material cost, but how much of a lag is there with regard to that pass-through with regard to raw material costs? That's the other thing I'd want to know better. The fourth piece is with regard to reformulation. Now, generally, when raw material costs go up, you start to see reformulation in process. So what happens is that customers start to change the formulation to skew down the raw material costs which have gone up. So because of that reformulation, what happens is margins come off. And as a result of that, that's exactly what's played out. This, of course, management says has happened multiple times in the past, but can this change? Are we turning a corner? Is what I'd want to know and understand. The fifth piece is with regard to competition risk from China. At least at this point, that doesn't seem to be in the areas of specialty surfactants that Galaxy Surfactants caters to. But could there be a risk emanating from China? The last piece is in Q1 FY26, the management suggested that the aspirational RoCE of the company, once everything starts to normalize, will be above 22%. The question, therefore, is how quickly do we get there? Because that will likely shape the turnaround with regard to profitability as well as growth. Now, let's understand the company better. It was incorporated in 1986. It's a surfactant manufacturer of specialty ingredients for consumer products. I'll describe surfactants in just a bit. It's not part of any larger business group. It caters to home, personal care, beauty and wellness industries. Now, in terms of what surfactants are, they're compounds that lower surface tension between two substances. So therefore, let's take a very simple example of soap, right? That's what a surfactant is. It's material such as oil and water, which is a primary agent that enables lather or foam. Performance surfactants and specialty surfactants. Specialty surfactants are slightly better grade, premium. Performance surfactants are based on performance for cleaning utensils, for shampooing your hair, or for washing your hands. 3 different surfactants, use case basis, right? So that's the split. In terms of the product split for Galaxy, performance surfactants, which is the surfactants I just described, is 60%. Specialty, which is premium, is 40%. In terms of end use, there you go. That's on your screen. Skin care, hair care, oral care, home care. All of those, including sun care, cosmetics. And then you have mild and premium surfactants also, which it generally manufactures. But those are the end products it typically caters to. In terms of business model, vegetable oil and pet chem is what they buy as raw material. They manufacture in India, US and Egypt. They sell to 1,450 multinational, regional and niche consumer companies. And they follow a cost-plus pricing arrangement with most of them. But of course, those will likely change if raw material prices go up. Reformulation is what is playing out. That's what I'm trying to talk about here in the cost-plus model. In terms of customers it serves the premium customers as well as the lower end, HUL, Colgate, Reckitt, Dabur, Himalaya, Minimalist. It serves pretty much the entire value chain. At least these are India-based customers, not just key global customers, but India-based customers. Global brands like the Honest Co also is what they service. In terms of geography or sales, India is 40%, Africa, Middle East, Turkey is 24%, rest of the world is 36%, includes US and EU. Now let's talk about the metrics. Let's try and understand what the company has done, and you'll see that the headwind that it has faced over the last 3 years. We saw a bump up in FY25, but thereafter it's just been so difficult. It's been a tough 2-year period for the company. Sorry, FY23 we've seen a bump up. Thereafter it's been a tough 2-year period for the company. The top line growth is just 5% CAGR from FY22 to FY25. In terms of the growth itself, it's picked up. I'll talk about that. But look at EBITDA numbers as well. Largely 6% EBITDA growth is what we've seen over the last 3 years. That's the EBITDA CAGR. And you look at profit CAGR, it's at around 5% profit CAGR over the last 3 years. In terms of the 9-month FY26 versus 9-month FY25, there's been 28% revenue growth, no EBITDA growth, absolutely flat, and a negative 11% PAT growth. That reflects the kind of headwind that the company is facing. But we've started to see an inch up with regard to margins, and let's just talk a little bit about that. In fact, if we can, we should look at FY26 Q1, Q2, Q3 margin number, and what we've seen there is we've seen an uptick with regard to margins. Margins bottomed in Q2, thereafter we've seen an uptick. Now how sustainable is really the question, and that's one of the other questions I want to ask management. 8.3% margin in Q2, but 9% margin in Q3. So we've seen that uptick happen. Is the company turning a corner? That's really the question. In terms of the balance sheet as well, and this one is neutral because the margins largely depend on raw material prices, and therefore that dependency keeps us neutral, because every time there's a turn with regard to the cycle in raw materials, you will see an impact on profitability. Now let's look at the balance sheet. Now nothing much in terms of adversity seen here. 2,400 crore in terms of the equity shareholders funds. Let's go back one slide, please. The balance sheet has 2,400 crore in terms of book value. Around 7,000 crore is the market cap currently. You're seeing a borrowing number which is sub 200 crore, so no concerns there. And that's the H1 FY26 borrowing number. We should have that as well. Cash in bank is around 250 odd crore in terms of cash bank, so no concerns there either. You look at the cash flow from operations, it's sitting very, very healthy in that sense. The conversion is very healthy, 87, 112, 101. No concerns there either. A clear thumbs up with regard to that as well. You look at return ratios, they've been between the 16 and the 25% band, in fact, over the last 5 years. So we've seen choppiness here, which is a problem, but it's been above the 15% number, which keeps it fairly healthy. So the return ratios are actually quite healthy in that sense, even with the choppiness. So a thumbs up there. Of course, this choppiness depends on raw material prices and the way in which demand shapes up in the global marketplace. And that really is the outcome of both of those. Let's talk about the shareholding pattern. 71% held by promoters, so no concerns there. FIIs, now this is where the trend gets very, very interesting. They held 3% in FY23. At the end of FY23, they currently hold 4%. And slowly they've inched upwards in terms of that 4%, 4 point something. They've inched upwards there. DIs also have done that. So smarter investors have started to come in and build positions here, it seems. ICICI Prudential, in fact, S. Narain's fund has come in and built a position here. So that's something that really caught my attention. The public also holds 12%, but it's on a reducing trend. What we've seen is number of shareholders have compressed, which means that the likeness towards the stock has gone away. This is currently an anti-love theme currently playing out where Galaxy Surfactants is concerned. Very, very important when you're looking at the shareholding. Some of these patterns look very, very interesting. You're looking at the analyst view, 9 buy calls, 4 hold calls, 1 sell call. But the upside is what attracted my attention. 23% upside is what analysts seem to be suggesting on this counter. You're seeing valuations, 22 times 1 year forward price to earnings, 19 times FY28 price to earnings. 5-year average is 27 times, and the 5-year range is between 20 and 36. So it's just come off the lowest point of that 5-year range. And that's what it is offering at 22 times. That's the valuation, which is why we are again positive, just 10% above that 5-year low that we've seen in terms of price to earnings. What I want to know now, let's try and understand that. On the other side of this break, we'll have the management of Galaxy Surfactants come in and speak with us. Stay tuned. Of course, this conversation is going to be fun. Welcome back. Now we're joined by Mr. Natarajan, who's the MD and CEO at Galaxy Surfactants. Mr. Natarajan, apologies for this, for having to make you wait. That's one. Second, I have just 9 minutes with you. So I would request you to keep your answers super crisp and super quick. Mr. Natarajan, let me first start off by understanding how things are playing out on the top line and on the margins. Because your performance in terms of top line has been very impressive this year, but it's not converting to margins. Is it still raw material pressure? Is it India, US? Is it reformulation? What's playing out?
Yeah, so first is I would like to correct one of the understanding, because we always report volume growth, because our performance surfactants category, we pass on all the raw material increases, so the margins don't go up in line with raw material prices going up. So we always report volume growth as one of the markers, and that has been flat if you look at it for the last 9 months as well. So that's something that I would like to state, because we don't look at revenue numbers. We guide the market to volume growth and EBITDA per metric ton.
Point taken. So when does volumes recover for you? And margins have compressed. What's causing that? When does that bounce back? Give us a sense.
Yeah, so this year we had a multiple of headwinds that impacted our volume growth as well as margins. First is the India growth has been pretty flat, and that is also apparent from the commentary that my customers have indicated in India. The second is the GST rationalization, though good for the long term, has impacted volumes in Q3. The other major impact from the international arena has been Europe continues to remain impacted by inflation, and our projects there on special ingredients are not progressing at the pace at which it should. The other thing that hit us last year was the US tariffs. Thankfully, that is behind us. At least we know that it has come down from 50% to 25% as of now. It will come to 18% once the final details are signed off.
So what does that do to your volume growth, therefore? You derive around 35% of your business from rest of the world, around 25% from Asia, Middle East, Turkey, and the balance from India. Talk to us about that rest of the world component. Does it go up substantially for you in terms of volumes, at least maybe over the next 12 months, given that there has been this unwind both in US as well as EU?
Yeah, it's logical to expect that to happen. But I'd say that the EU, the deal that has been done, it has no significant implication for organic chemicals, because anyhow, the duties were around about 4 to 5% under the generalized system of preferences, GSP as we call it. So what would come in as a plus would be once we start progressing all the projects that our US customers had suspended once the tariffs were announced, somewhere the beginning of last year. So that's something that we are watching, because now we are seeing that customers are encouraged to start progressing the various projects, and we should see some green shoots coming up in the ensuing months.
Okay, and the reformulation play, which you're currently facing, you've suggested you faced it a few times earlier. When does it unwind? Because that is probably what's keeping a lid on margins. Is my understanding correct? Would you want to change that?
Yeah, so that is also reformulation also, which some of our key customers have resorted to. It's because of the way the oleochemical prices have really enlarged its gap vis-a-vis petrochemical, and some of them have resorted to because they need to have their costs in check. Now this we have seen it happen earlier as well, but it used to be for a short period of time. Here also it has happened over the last about 1 year. So the correction can happen only if our oleochemical prices correct. We would get to know about that in the coming months because these are the high season months for production in Indonesia and Malaysia. So we do expect that things to start correcting, and that should have some positive implications for the reformulation to act in our favor.
And will that help in margin uptick, Mr. Natarajan?
It will, because what has happened is that the volumes have got significantly impacted in terms of the reformulation. So that coming back itself would give you a better operating leverage. That is one. Second is, yes, that's a product in which we are market leaders, and it will certainly enable us to get the margins back on track.
So we've already seen an inflection there in Q3. You expect double-digit FY27? Is that something that one can start to pencil in?
No, that's not something that I would want to communicate, because our guided range is 6 to 8% growth. For that, India volume growth coming back is critical. For our specialties, it has to be the US, the entire Americas and Europe. So I would say that this year probably will end a little bit positive. We have been flattish for the first 9 months of the current financial year. The next financial year, I'd still stick to my guided range of 6 to 8%. I would have more clarity once we get into the full year results discussion in May.
Point taken. Mr. Natarajan, I was speaking about margins. Margins doing maybe 10% next year. Is that something that we can pencil in?
Yeah, you can, but that's obviously, I see it likely, but the critical success factor for that is how our specialty business in the Americas and Europe start shaping up. Given the tailwind that we have now of the US tariffs coming down, okay, we do see that as a possibility. But there again, it depends on how well our project starts getting reinitiated by customers, and we are positive about it. But I'd like to make a clearer statement only when we meet in May.
So a double-digit margin FY27. When do you get to the 22% RoCE, which you've suggested will come eventually in Q1 FY26? In your commentary, you suggested 22% plus at some point. Do you get there FY28 maybe?
No, I think we'd see a very positive movement happening in FY27. And then, yes, probably FY28, we should get into our stated target of 22%.
Understood. And with regard to growth, you've suggested around 6 to 8%. I know that you're firm with regard to that, but on the domestic side, are you seeing things turn around as well? Are you seeing those initial signs? Because you stand at a place where, I'm sure that your customers contact you first as soon as they start to see demand spark.
Yeah, so we are seeing some, positive movement. But then, it's always better that you see it sustaining at least for 2 quarters before we can make a clear statement. But the positive thing is that the momentum seems to have reversed positively. So let's keep our fingers crossed.
Okay, Mr. Natarajan, it's been a pleasure. Your stock is up, obviously, on the back of the commentary that you're providing. And it's quite positive in that sense as well. Viewers, that's all the time we have on AYC today. Thank you so much for coming in and watching.
This is worth sharing.